Good morning and welcome to Equity Story Trade Watch Wednesday. I'm here with Claude as per usual, 19th of July, and we've got a pretty interesting week this week because we had a really strong finish towards last week after we talked on Wednesday, and we've got a bit of a continuation of that as well this week, which is nice. So it looks like we're maybe back on some sort of positive territory here, Claude, and some good-looking charts, by the way, as well. We've got our thought of the week, which we'll talk about in a sec, and some announcements. But before I start on rambling around, we've got the Equity Story disclaimer in front of you. Of course, every story we talk about is based on technical fundamentals only, so that means it's general advice only. Okay, let me swap screens. That's the first thing I need to do because I need to show you what's been happening pretty much around, and I'm going to straight jump into the commodity space. So we've seen the markets being positive last night in the US. I think the Dow jumped over 1%. I think the Nasdaq was about 0.7, but it is a positive theme coming through, and that's on the back of last week's positive data on inflation. And of course, we've also got some start to the reporting season in the US, Claude, which looked fairly positive from the banks to start off with, right? So I don't know how it's going to lead, of course. There's a little bit of hope, hopefully, that those tech stocks will report quite well. They probably need to, because some of these tech stocks have come up quite significantly and they've been charging along. So they need to actually deliver some of these pretty strong quarterlies. So that maybe that's a risk there. But it's a nice start to the quarterly reporting season in the US, which is nice. So let's go from there. We're going to go to commodities, which we've had a look at this morning. Gold going up back to the $2,000. That's pretty good. We've seen some nice charts in the gold space, EVN being one of them that looking very, very, very good. There's some others that are looking pretty good as well. So hopefully those trades, if you're on them, hold them because the gold's still going up. Iron ore starting to recover, up 7% for the week. So that's good for some of the iron ore miners. BHP doing quite well. I saw CIA doing quite well as well. That's nice. I had a look at let me see that oil and gas was pretty good. That's also reflecting on some of the share prices. And then we go down to the base metals, which is copper, up 2% almost for the week. And some of the other ones are positive. That's good. And I did read some commentary saying commodity space potentially looking like a contrarian coming through and recovering. So maybe that's why the investors are getting interested in that space again. All right. On to our announcements this morning. So I'm going to show you some charts. And again, I'm going to flip the screen back to Reuters so you can see what I'm looking at as well. So I'm going to start with, and you can jump in at any time you like. So I'm going to start with ALD. And these guys, we've been looking this at a dividend play, really. And you can see that the chart's looking very, very good. It's recovered. So they had that issue with one-off incidents near Geelong. Looks like it's recovering on the way back. Pretty strong update today from the looks of things. It's looking quite good, I have to say. That's a good-looking chart. If you're in this dividend, you got to be liking this and maybe even buying it. So, if we're looking for a dividend play, one to have a look at. Next one, we're talking about gold. So let's look at NST. They come up with their quarterly as well. And again, wasn't too bad. Let's have a look what the chart looks like. The market maybe didn't react to positive today. Let me have a look. Nah, down 5% on that update today. I had a look through it. Look, there's nothing incredibly bad in there. It was just okay. The all-in sustaining costs are about $1,700. It's not neither here or there. At the end of the day, you're probably playing this. While you're playing this maybe on the production and costs itself, you're playing this on the gold price as well. So unfortunately, the results wasn't as good as probably the market expected. So down she goes. But I still think as a gold play for if you're trading this, it's still holding. So just wait till Friday, see where it ends up. If you bought this on this green candle and see how it goes. I certainly wouldn't be panicking on that. All right, let's go to the next one. FPR, I'm not sure if you know anything about FPR, Claude. This is the fleet partners in that MMS space, right? Did you have a look at this one at all this morning?
not really.
That's okay.
This morning. No, sorry, Peter.
That's all right. I didn't mean to throw you under the bus there. But okay, if you didn't see it, I'm just going to quickly update it. Is the numbers actually look pretty good, in line with what MMS has been coming up through, and one of the other players in this space as well. So you can see the space is going quite well, and you can reflect this on the share price, right? It's a beautiful share price going up through, and if it gets through that 260 by the end of the week, this is another buy towards the 280. So if you're in this as a trade, maybe bought it on that one or bought it on this, you're still in this. And I'd probably hold that $2.40 as your last line of defense as a trade. So quite positive. I have to say this sector is going quite well. And I know you like your MMS and you're regretting not getting into it, but that space is still going quite well. And possibly there's some more upside still to come, Claude, from what I've been reading from FPR. So not bad at all.
You've still got the narratives, and the business isn't bad either. So even though I haven't looked at it today, I have sort of had a positive view of it lately.
Okay, excellent. I'm going to move on to Rio and just a quarterly update from them. Again, it was, if you look at the numbers, unless you're going, oh my God, some really bad numbers, you don't even blink an eye. It's like okay. Pretty much fairly expecting what they're going to come up with. The numbers will vary -4.35% to +3.45%. So nothing really too exciting. I think if you're buying on that candle there, you're still holding. I wouldn't get too carried away with anything that they've come up with today. I had a quick flick through. Like I said, I didn't see anything super negative in there. So if you're trading these, you're probably going for maybe the exposure to copper and iron ore. And they are going, well, iron ore is going okay. Copper still going not too bad, but overall still decent, still okay for Rio as a hold. WDS is another one that come up with their quarterly numbers. And again, another one that's come out okay numbers and with nothing excited about. And again, very similar chart to Rio. If you're in this, got on this green candle last week, you're still holding, not changed that at all. Again, nothing exciting for me in that thing. And normally there isn't anything exciting in these things unless they've got a one-off announcement saying they're acquiring something or production is changing or something like that. But quarterlies are usually just a update on what actually happened through the last 3 months, right? So it shouldn't be too much excitement in there. All right, I've got 2 more to go through, actually 3 more to go through, and I haven't seen these charts. So let's have a look at these charts because I saw some announcements this morning. AVD. Claude, you anything about AVD? If not, that's okay because I'm going to move on to the next one. All right, that's okay. Look, I'm not a huge fan. I just have to look at it. We'll see what they've come up with. Maybe I need to have a look at it. Maybe we both need to have a look at this because they've got some decent revenues, but is this company like a reliable company? Is it something that rocks our boat? I don't even know, to be honest. So,
I wonder if they're a renamed company. I don't recognize the name.
Fair enough. Neither. Yeah, maybe that name rings a bell somewhere, but I just can't remember what it does. Next one, MSV, a little services company to the mining space, mutual services. Do you know anything about this one, MSV?
No, I mean, the name rings a bell. I think I've looked at it in the past, but no, I don't know. I don't know what.
Right, fair enough. Again, they come up with looks like a decent announcement with quite strong growth in the EBITDA side of things and profit. So I think I had a look at the previous numbers, Claude. So I just had a quick glance, really. So they had just a very, very, very slight profit in 2022. Looks like they're going to get around 6 million in 2023, right? So obviously a huge jump, but they must have had some issues last year where they didn't make any profit.
Yeah. So I've vaguely looked at these in the past. Like I think it can be a very up and down cyclical business with a lot of operating leverage. So I think they operate rigs on a sort of demand basis. So depending on how much demand there is, it depends on how much profit they make. So it can go up and down massively. Therefore, one of those kind of companies you would expect to go on a pretty low P ratio when it has a decent result.
Mm-hmm.
So for that reason, it's good to see that they're going to be paying a dividend. They've got a profit after tax of at least 6.5 million. To put that in context, it's a 90 million market cap at the moment. Now they do have some debt, but either way, not so expensive. So I think it's like a bit of a rebound story there, recovery story. You can see on the chart how volatile it's been. For a trader, I would be not against trading this, because come the next dividend payment and stuff, it's going to start looking a little bit better. They've paid down some debt reduction of 55%. So significant reduction in debt there. That's going to reduce some of the risk. It's also going to reduce interest costs going forward, which will be good for profit. So overall, you could keep trading it, but for a long-term company, buy and hold, it doesn't have much interest for me.
Fair enough. No, I agree with you there. I agree with you. I think, MSVs of the world, there's better companies out there. I think better track records out there as well. Less volatile, less cyclical. So
it's just a tough business, like capital intensive,
sure.
cyclical, prone to the ups and downs of demand. So just a very tough business.
The margins are very, very thin on these sort of things, right?
Yeah.
All right, I'm going to go to the last announcement, and I've been holding it back on this one because we love both of us love this company, and they came up with a quarterly today. So let's talk Dropsuite, Claude. So I'm going to let you go with Dropsuite because
sorry, I haven't contributed much yet, so I'll happily go on.
No, you have, but you like this company as much as I do, but I'm going to let you go first.
Yeah, so look, Dropsuite put out its quarterly today. Look, the news is nothing to worry about for sure. Operating cash flow positive, 0.34 million, so 340,000, about 300K in free cash flow. So definitely zero concerns on the balance sheet. Free cash flow again this quarter, 23 million plus in cash on the balance sheet. These guys can afford to run this business how they want. That's the key difference between the companies that say, oh, we're investing in growth, and they're not doing well because they are losing money every quarter. So they're going to run out of money eventually. They need to raise capital. Dropsuite could not be more obviously not in that category. Clearly, it could optimize more for profit, but the company's talking about continuing to reinvest. Peter's got it on the screen right there, in the global capability. So that has meant over the last 6 months they've put on more salespeople, which is, one would hope, going to increase sales. They continue to release new products, like they started monetizing their QuickBooks product, which backs up someone's QuickBooks data. So that's a new growth lever there. So overall, that makes total sense. The cash flow is fine. Now, the slight negative on this result is that percentage-wise, I think 8% quarter-on-quarter annualized recurring revenue growth, that's good. That's fine. However, it's not as good as last quarter. And if you look back over the last few quarters, for the last couple of years, they have generally added between about 2 million and a bit over 3 million ARR per quarter. And in this quarter, they added, I think, only 2.2 million. So this quarter is sort of at the lower end of their performance in terms of growth that we have seen over the last couple of years. So that's the negative. If it's doing in this range, then I wouldn't be overly concerned. So for all we know, it's going to be slightly stronger next quarter. And maybe it will, maybe it won't. But the point is, even if they just keep it up at the current rate of adding about 8 million ARR a quarter, then eventually this company is going to be worth a lot more. Now, that's not the best case scenario. If they keep on adding just that would be a slowdown. If they kept on adding 8 million a year in ARR, then it's going to take a few years for them to get 100 million ARR. And so that could be, the best part of the decade. But on the other hand, as I just said, they've been reinvesting in growth. They have been growing their team and they've been releasing new products. So actually, it's quite possible that in the next quarter, we'll actually see the ARR add a little better, because it does tend to fluctuate from quarter to quarter. It's not just smooth, exact same every quarter. It does go up and down a little bit. And if this is just a downer quarter, that's fine. It goes up again next quarter. We might find that these guys are run rating closer to 10 million or 12 million ARR per year, in which case, again, like it starts getting down to maybe 5 years to 100 million is possible if they manage to just inch it up towards that 3 million a quarter and maintain there. due to their expanded sales base, which is totally believable, then suddenly you could be looking at 100 million revenue in 5 years. It's possible. And in that case, I think you're onto a massive winner at these prices because, well, it's like 250 million market cap. Even if they only get 10% net profit margins on 100 million, which I think is extremely doable for a company like this on 70% almost gross margins, probably they can do 15% net profit at least. So you could be talking 10, $15 million profit in a few years. And that really starts looking, if you make $15 million profit, then I don't think it's going to be trading in a 250 million market cap. And that's also excluding all the possibilities that you could have a bit of growth accelerate due to an acquisition or something like that, which they've talked about. They want to make an acquisition, but they don't want to make a loss-making acquisition that plunges them into a loss. So yeah, multiple ways to win here. Maybe it's not, I think me and you are both sort of saying it's cheap around the low 20 cents range, just on the fundamentals. And I think that it's probably not as cheap anymore, but I think it's still fine.
Yeah, look, I agree with everything you said. And, like we've been trying to reiterate, you're never going to get a 10% growth every quarter. You're going to have 12% and an 8% and a 10%. It's just going to, I think you're going to take it as a full year type stuff. And, Claude, show me another company that's growing at 50% quarter or, corresponding period or on a year's basis. That's really still cash flow positive. So you can imagine if they really pump the money in and become, ridiculously throwing money left, right, and center, they could probably grow at 100% if they wanted to, right? The fact is, I'm happy with this 50% growth with cash flow positive, with the way Sheriff manages the actual company. So it's really, really impressive. And, if you look at the cash receipts, they now, if you annualize that, 24 mil, we can get to the possibly that 50 million within the next 2 years, maybe, right? So,
well, the old thing is, Peter, they talk about, for the bigger, more mature companies, the rule of 40, which is revenue growth, not ARR growth, but revenue growth plus EBITDA margin or free cash flow margin. Now, we're seeing that the free cash flow margin, look, it's probably going to be, I don't know, call it 1 to 2 million in the year. And the revenue that they're actually going to get for the year, we're talking about 30 million ARR. The actual revenue is going to be lower than that, obviously. But still, we're talking about a positive, result for the free cash flow margin. And we're talking about extremely strong revenue growth. That's the thing, like the ARR is up on constant currency 45%. Now, in terms of the actual revenue, it might be a little bit lower than that, but you're still going to achieve that rule of 40 one way or another. So yeah, basically it ticks the box there. I own it and I'm happy to continue owning it, and I'm still positive on this long term.
Yeah, but I mean, the thing is consistency, right? For a small company, it's extremely consistent, and you've got to sort of try to think for yourself, the risks are actually quite low that they're going to have to go to the market and raise some cash because he's a very good, operator.
I don't think that's going to happen at all. It's you can't give it up. I'll tell you why. Like, I'm not. So I know you took a bit of profits before this, which is fair enough. But the reason I remain bullish and I'll probably just still not be taking any profits is because obviously I own shares. But my thinking is this, Peter. Like, this is in the AFR the other day about la-di-da tech stock that's up 70%. Great. But more people are thinking about this now. It's a $250 million market cap. It was a bit smaller before. Small cap funds are definitely sniffing around this already. Absolutely 100%. On top of that, this is one of the few vaguely credible cybersecurity plays on the ASX. Like, there's not many companies that really give you any kind of real way to try and benefit from that increasing demand for cyber products. You do have a bunch of IT consulting companies or adjacent companies that have part of their business around cybersecurity. I think Mac Telecom was one of that, very expensive, great business. I think there's a few others that have some sort of adjacency to cybersecurity that helps drive demand. This is probably the purest, profitable, growing actual company that's like, oh, are you worried about hackers? We have a solution for you. So if they can keep growing, then I am 100% sure that there's going to be more people looking at this. And then whether people get across the line or not, I don't know. But this definitely has the potential to become a very crowded trade at some point in time. And that is when I want to take a bit of profits. But right now, it's not that absurd, because you can easily be like, oh, I can definitely see how this company in 5 years looks cheap today. But I think it could be one of those where it gets to a point where you're like, oh, wow, even if this thing goes well in 5 years, it's still not that cheap. And that's when I'll probably be more of the mind to take profit. But right now, I still see it makes sense. It could probably go to 40, 50 cents before I'd say it's like there's not much upside that I can count on.
Yeah, look, again, agree. Just technically speaking, the reason I took the profits yesterday, and when I said profits, a very small amount of cash off the table, because we obviously had a quarterly today, possibly, if they didn't quite come up with that 10, 11% growth, I thought it could come down. It's true, it's coming down. So my profit taking was a genius move. Thank you very much, Claude.
Yeah, no, you nailed it.
And after buying that back up at 30 cents, thank you very much. So I'm still happy. I've still got a lot of the shares, but I'm also happy that I've taken some profits. And if it does come back a little bit, this is your opportunity to get some.
Yeah, I think I'm feeling positive about these guys. Nothing's going to kill them. Like, market sentiment can totally push their share price down. Disappointing growth or increasing expenses can stifle their free cash flow. But he has shown every sign that he's going to keep it free cash flow positive. All the communications are saying we're going to reinvest while keeping positive free cash flow. And that's also what has now happened for 5 quarters in a row. So what they say they're going to do, what they're actually doing, lining up perfectly, and it's a good plan.
And the other thing is, he's been talking about acquisitions and he hasn't pulled the trigger yet, which just shows you how potentially careful he is not to buy something crap that it's going to kill all that, right?
Yeah, and that's why you've also got you've got this 23 million in cash that they don't actually need really now. Like, if these guys had 3 million in cash, it wouldn't really matter, because their quarterly positive cash flow is positive.
I like it.
And it has been for 5 quarters now. So they're not having these big draws that, or at least not we're seeing at quarter end, this sort of big need for capital. So as a result, it's overcapitalized, you could say, which means that they can probably just plonk down 15 million and buy something if they see something good.
Great. All right. I think we've done it to death. So let's go into the thought of the week, which, the question was posted because every week we look at something, right, that catches our interest, whatever. So I'm going to get into your brain. I want to see what you're looking at the moment. So even if it's not fully complete, right, I want to see what you're looking at right now. And I'll tell you what I'm looking at as well this week, that I'm trying to sort of more understand, that potentially looks quite good. So please go ahead. What have you got for us?
So today I've got one for you that actually did an announcement this morning as well. Australian Ethical Investment, AEF is the ticker. That's obviously come down a long way with the markets, yada yada. It was totally overhyped, etc., etc. Very, very crazily priced for a while there, but it's come down extremely. And so today they've basically, I wouldn't pay too much attention to the 48% farm growth, because they had some big one-off events there in terms of Christian Super joining them. But basically what you can see is a little bump up quarter on quarter. Good to see the net flows there. I'm just ignoring the market and other. Even just looking at their net flows, that's what matters to me the most. That's mostly just people just continually putting into their superannuation. That's the whole thesis for AEF. They have a cohort that are skew younger, so they've got further amount of time of just putting into their superannuation and not taking it out, compared to like most superannuation providers. And that is favorable. Also, as these people get older and get more senior in their careers, on average, their salaries are going to go up. Not only that, but this is also like, as inflation drives up wage growth, that also drives up the amount of money these guys are getting into their super. So it's a company that automatically just rises as there's more money in the system with inflation. So that's fine. obviously subject to market movements, can go down when market goes down, can go up when market goes up. But if you just look through the market movements and just ignore that for a moment, I think you can easily and safely model like 6% fund growth per year just from contributions. I think you're safely going to get that if you just put aside market movements. So on top of that, they've recently given out their guidance for their underlying profit after tax. I won't get into all the adjustments right now, but suffice it to say, I think that the underlying profit after tax is roughly right. And, you know, eventually in most years, statutory profit will match that. It's not great though. I'm not saying it's the same as statutory profit, but the point is, I think it's reasonable enough to use as a proxy for valuation. You use the low end of that. These guys are on, I think it was like 11.3, the low end of their underlying profit after tax, with around 400 million market cap. So around 40 times, or a little bit less than 40 times, 38, 39 times low end of earnings. Look, that does seem high, but as I just sort of said to you, I think that there's sort of 6% growth, kind of all else being equal, that it's just going to happen. Now, if you have 6% growth to revenue in a fund manager, at some point, now they have been increasing their costs lately, which I'm not happy about, but at some point they actually don't need to increase those costs as much. And in theory, the actual profit growth should be better than the 6% kind of revenue growth, or sorry, 6% fund growth, which then translates at least somewhat into revenue growth. On top of that, so I therefore posit that actually, you know, probably all else being equal, profit growth of higher than 6% is possible. And then on top of that, you've got two other factors. You've got the markets actually just go up over time. Now they've come down a bit lately, but they go up over time. So over time, what I posit is actually the fund growth will be higher than 6%. So again, this is all painting a picture where I say 10% profit growth for a long time, because it's structural, is very likely, very possible. And then on top of that, you've got the fact that they get performance fees from time to time as well, which boosts their profits. So a couple of little kickers there. I think the worst case scenario, you haven't overpaid badly at current prices. You might have overpaid a little bit if things don't go too well. But if things do go well, and the fairly conservative case that I've just laid out for you in simple terms turns out to indeed be conservative, and actually they manage to sustain, say, 10% profit growth for a long period of time, even if you just start with 11.3 million, which is the low end of guidance, then you can easily see that's like 18 million or 18.2 million in 5 years. Again, that puts it on, you know, basically 20 something low earnings here. And like, I'm thinking that actually this kind of growth rate, 10% ish, can probably go on a lot longer than 5 years. Because as I said, this growth rate is not arising from some, you know, market dynamics or something that's a temporary thing. It's like on a superannuation timeframe. You know, you've got a cohort of people that are in there, mostly Gen X and millennials. They are in their 40s and 50s. These people have a lot more than 5 years of putting into their super, a lot more. So you've probably got 10, 15, 20 years of better than system growth on this company. So as a result, in the long term, I say it's undervalued.
Okay.
But, you know, that's the idea I'm working on. I'm basically, look, it's obviously been a tough time, and I'm look, Dave would be not that impressed, I guess, because there's bottom picking. So I'm kind of,
Dave is not here. It doesn't
yeah. But like, what I'm saying is, I feel like, you know, dare I say it, I do kind of feel like probably the bottom has been in for these guys.
I think you're right. I mean, look at the charts, you know, the technicals saying, yep, you've got probably the bottom around at $2.90, $3. It's on a recovery path. It's, yes, Dave would say it's probably a little bit too early yet. We just need to get it over that 380. It's not that far away. It is recovering. So maybe another month, maybe in August, we'll see this, you know, above this. Obviously, like you said, the Christian Super is the big one that added the growth to the FUM. But you know, I can understand, and you make quite a nice case for this company. So
I don't own this yet, and I haven't finished my work on it, but you know, this is what is animating me this morning.
Well, I am halfway through my little analysis of a company called DUG, which I know we had a look at a few times. So this is my idea right now. I mean, it's fascinating me. I have to say, the more I read about it, I'm thinking, oh, this is quite interesting. Look at the charts. It's been actually quite bloody on a tear, right? And I remember we looked at it roughly around the 60, 70 cents mark when it first popped up on our radar, Claude. And I've been pretty slow. I have to admit, I have been pretty slow to get onto it and have a look at it in a bit more detail. Some of it is getting beyond my meager knowledge because it's high performance computing, which can be quite technical. But the recent announcements have been very positive, and it's been driven by its services business. About 80% of it has been growth right there. So I'm just going to go back to show you exactly what I mean by that. So I'm going to go back to February when they released it. And here we go, the presentation right there. And I want to just show you the breakdown here of this business, and I'll quickly show you exactly what all these businesses do, because this is quite interesting. Predominantly, at the moment, it's earning most of its revenues out of the oil and gas industry, right? But from the looks of it, with the size and processing, all the sort of things, that the services business side of things. But there's 3 business units that they've got here, and once it comes up, you'll see exactly what I mean. But the growth has been phenomenal, really, over the last 12 odd months. And I think the FY23 will be very, very strong. That's why it's been pushed up so ridiculously high. I don't think it's cheap anymore, so to speak. And I know you asked me right at the beginning, do you see still value in this? Yes, if certain things come off for them, like this, technology and stuff. And yesterday they had a little announcement about this getting funding, 5 million out of the Australian government or WA government, funding the little. It's not a sort of a data center, it's not like a whole center. So it's like a micro high computing center for them, which is quite interesting. Again, trying to get my head around, okay, say like an NXT versus HP, this is HPC type stuff. There is quite a bit of differences in there. So anyway, let me show you the breakdown here. So you've got the contract wins as well, going quite well. This is the US, by the way, as well. So you can see it's going very, very well. If I go down to software, growth of 9%, right? This is that high performance computing revenue of 2.2. But remember, this is everything's still growing. Even though if it's a small thing, it's still growing. This is the one that's really putting off 60% growth, 20 million in US revenues. This is what the market's excited about. But I'm actually more excited about this stuff here, to be honest, because I can see potential of it if they do quite well. And if you start reading about this, Claude, and I'm not going to flick back to the screen that I was looking at before. This is why it's quite interesting. And let me just go back here. So if you go, it's actually quite high-tech AI type stuff, business potentially, right? So if you go to this, let me see, I think it was here. Whoops. You've got this software and algorithm support, right? So they actually provide, or at least have got a system where they can help you with algorithms for whatever your search engines, for anything that you might need to get people to click on your website or find you, or whatever you might need. Algorithms are a very, very important part of computing these days, right? So algorithm development here is one of the interesting things for me when I started reading about that. So this stuff here is high-tech business. And they've been going quite some time. It's not as if they've just popped up from nowhere. They've actually been working on this for quite some time. So that's quite interesting. Like I said, I'm still halfway through reading all this through, but I'm liking what I'm reading here. It's very interesting. And I think a lot of people are still probably missing the point exactly what they do. So the data set, this is what the actually really strong growth is coming out of. The seismic processing, the data blend. One of the other things to talk about is the full waveform inversion, which is again high tech, beyond me. But when you look at it, you sort of understand exactly what they do. This is all about potentially application to the oil and gas industry in there. And then they've got this Dagmar cloud as well, which is quite an interesting part of the whole ecosystem that they're actually trying to create here, which has got that high performance computing, which is the data center. And they've got one in Houston, I believe, the storage service and software. So 3 business units, all very interesting, a little bit complementary as well. However, they're still quite not gelling for me, but I can see what they're working on, and I can see quite a interesting, exciting business in a way over the next few years. So if they can play the cards right, and this starts growing, this HPC of it, I can see big potential here, Claude. So look, I'm still trying to read through it and get all this financials and everything else through. And I'm probably still going to stay away from it until I see the full year results. That's next month, right? So I want to see the breakdown of everything, exactly how the cash flows are going, exactly what they're spending. I need to see all that before I get into it. But I like what I'm seeing over the last 12 months. And so that's what's been my driver at the moment. So if I go back again, show you that screen, this is why I'm liking this, all these sort of numbers here. The services, so I'm going back to the outlook now for the company itself. You've got services order intake has increased working hand to 28.8 million. This is US, so it's about what, 40 million bucks, Aussie dollars. So that's up 30% compared to 2022. And this is again strong growth for me. Strong growth. A company that can get that 50 million percent growth, sorry, 50%, the 30% growth on 50 million, that's pretty strong for me. It's got to be on my radar. I need to have a look at it, and I'm looking at it at the right moment. But let's watch it. I know some of you may be trading this already. I'm going to start accumulating if it comes back a little bit to that 120, 130. But I'm still waiting for that full year result. So I'm not going to fully commit. I'm still going through it. I like it.
Nice. Thank you for that, Peter. Yeah, I definitely think the high performance computing is an interesting part of it. Obviously more recurring in nature as well. So I think my big concern has always just been, look, what if there's a really rough quarter or a tough quarter on the services, which hasn't happened recently. And honestly, it's great if you caught the run, because it was a huge run since that started picking up. So yeah, wish I'd been on board this one. Definitely does deserve to be on the radar. Yeah. Perhaps one to pick up after a bad quarter on the services revenue even. I agree. Like I said, consistency is one of the key parts for me. Like DSC is very consistent. I'm still not sure how consistent this is going to be, especially when they actually are contract type business for majority of its business at the moment, right? So like you said, you could have a really bad quarter where there's not much cash flow coming through because the contracts haven't been signed in a particular quarter or whatever, right? So I'm just... I'm still trying to get my head around exactly how consistent this guy's going to be, whether they can actually keep going that 30% maybe per annum. But so far, I'm liking what I'm seeing from the technology part of things. So yeah, one to watch. All right. Claude, thank you so much for joining me. I appreciate, again, as always, having you on board talking fundamentals. Have a great day, and I'll see you Friday. You too. Thanks for watching, everyone, and thanks for the chat, Peter. Thank you. Cheers.